Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to walk you through how we construct a ETF portfolio. It's something that we get asked a lot about in the questions and the Q&A. Quite often listeners ask us to sort of critique a portfolio and also get similar questions over on YouTube as well. So I thought I'd walk you through it. Look, it's not for everyone in terms of constructing their own ETF portfolio. And I guess the other thing too is I'm very happy to openly share how we go about doing things. So it's not about not trying to undershare information. Hopefully that's relatively clear by now. For anyone that's been listening to the podcast for a long time, I want to share as much as possible. But I guess the other thing too is sometimes, you might share an approach, but there is also nuance, and there's nuance in every profession, I guess. And so if you just think about that and you relate it to your own profession, what and then relate it to, if we sort of change sides of the table, if you like, if you're doing a podcast on, what and I'm the novice, you would understand where that nuance is and where experience plays a role and so forth. And constructing a portfolio and how you invest is a really important decision because we can't control market returns. They are what they are. We can't control fees. We can pick which funds, but at the end of the day, fees are certain. What we can control, though, is where, how, and when we invest, really. So it's a thing that we should focus probably our most attention on, buying something that's really good quality, hold it for long term. And, if we do a great job, we capture those returns. If we don't do a good job, we won't. And so I don't want to overemphasize the skill and experience that goes into constructing an ETF portfolio, but I also don't want to underemphasize it either. And whilst I'm keen to, go through today's episode and share what I know, I just want to put a really big disclaimer on there to say, well, if you don't have the skill and experience, if you're dealing with large numbers, be careful and think really carefully about whether you should get some advice. And I know I have a vested interest in saying that, but the only reason I want to say it is because I don't want people to misuse the information in this podcast to their own detriment. I mean, I don't have a dog in the fight. Like if you get advice, you don't get advice, it's not going to really change my life. I don't want to sound like a selfish perspective, but it's really not. But it could change yours. And I guess that's the thing. So, okay, how do you build an ETF portfolio? Well, your first option is just to use diversified ETFs. So Vanguard has an all-growth diversified ETF. The ticker code is VDAL, and BetaShares has one too. The ticker code is DHHF. And they're both, pretty robust products. They've both got their pros and cons. BetaShares has slightly less invest in the Aussie market than Vanguard, which I think is better. But Vanguard has some exposure to smaller companies. BetaShares doesn't include that in its asset allocation. So, look, you can probably critique them both and pull them in different directions, but I'm not sure they're materially different from that perspective. BetaShares is a little bit cheaper than Vanguard, but again, we're not really moving the dial with the fees that we're talking about. And a diversified ETF solution probably suits a few different scenarios. I mean, if you're investing a relatively small amount, you don't want to overcomplicate it with one trade, with one ETF holding, you can get a diversified exposure. And that's typically perfect for when we're investing for children's, which is a very common question we get asked. Just go buy a diversified ETF, something you can buy $500 worth each year, around birthday times, those sorts of things, and add to the portfolio. If you are in a situation where, you from a behavioral perspective, you're likely to tinker with things if they become too complex. One of the advantages of a diversified ETF is that you're less tempted to really tinker with it or make some silly decisions with respect to, investing further money. So, if it keeps it nice and simple and you're going to overthink it, then a diversified ETF is best. And of course, if you don't feel like you've got the skill and experience to go through the process that I'm about to outline to sort of construct your own ETF portfolio, a diversified ETF is best in that situation as well. So why don't we use diversified ETFs? Well, there's a couple of shortcomings that I think are important to highlight, that we think a bespoke portfolio mitigates or overcomes. The first weakness really is that you are locked into really investing across a relatively static asset allocation across various geographical markets, regardless of how attractive those markets are from a valuation perspective. Now, that is true, but not strictly true. It's not strictly true because both Vanguard and BetaShares will have an investment committee and they will be considering things like valuations and how they allocate. And so they will have a sort of strategic asset allocation and shift that dynamically, so that if they feel like the US is overvalued, they might go underweight US. But the thing is, they're not going to move too far away from the strategic asset allocation. So if their neutral benchmark is we're going to put 35% in the Aussie market and the Aussie market is priced attractively, they might put 37%. And if they don't like the Aussie market, they might put 33%. But either way, you're still going to put a reasonable proportion in the Aussie market. And that is true regardless of how attractive it is. So whilst they do move at the fringes, at the edges, that are not really making substantial changes, and nor can they, by the way. I mean, they want a product that is well diversified. That's its value proposition. Of course, they're not going to do that. But we think that doesn't always make sense. Why would I invest in the Aussie market or the US market if I didn't think it was a good time to do that? The second observation is that they tend to, they don't tend to, they do rely exclusively on traditional market cap indexing. And I've previously spoken about the shortcomings of market cap indexing, that your allocation is linked to share price. And as a company's share price rises, holding everything else constant, then that company, that name is now more valuable relative to the total value of the index. And so more of your money goes into it. And so it's really following price, and price isn't always the best way to allocate how you're going to invest across an index. Now, they have to follow traditional market cap indexing because what they're trying to do is they're trying to appeal to these diversified products are built for, novice investors, and they know novice investors are going to look at price and fees. So, and that, in fact, that's how some people will just choose an ETF based on price, and they'll go for the one with the lowest fee. So the way to deliver the lowest fee is to choose a indexing methodology that's the most cost effective. And because traditional market cap indexing has attracted the most volume of money, it's got the most scale, and so it can deliver that at the lowest cost. Now, it's going to be hard to design a diversified ETF and compete with BetaShares, for example, that charges 0.19%, and try and charge 0.4 or 0.5%, even if you are using different methodologies. It's going to be hard to attract that sort of money. I mean, as I look at it, in fact, BetaShares ETF, diversified ETF, has $1.1 billion in it. So, it shows, I think, that price is a really big consideration for many investors. And I'm not saying that's the best way to go, of course, but that's the reality. And I should mention, actually, relating to the previous point in terms of you've got this fixed asset allocation. Remember, Campbell recorded an episode back in February, episode 397, where he sort of spoke about the relative lack of attractiveness of the Australian share market, and that we couldn't really see where future returns are going to come from, given that it's dominated by financials and materials, being the miners and the banks. And the miners and the banks are pretty fully priced at the moment, as a general comment, not specific to each one of them. And for that reason, we thought it didn't make sense to allocate so much to the Aussie market. So I guess when you use a diversified ETF, you're doing that, and it doesn't necessarily make a lot of sense. Okay, so how do we go about building a portfolio? So the first step then, it's a two-step process. The first step is start with quality. And really, the index that you're buying must pass the forever test. I spoke about the forever test back in March in episode 399, where it was really about holding an investment forever, buying something that, an index that you have deep conviction with, that is not a thematic. And really what you're trying to do is choose an index that you'll be happy to own for the next 20, 30, 40 years. So thematic indexing is really investing based on a narrow theme, but just because you think that theme will play out for the period. So there's a few different ETFs, like cybersecurity ETF that invest in cybersecurity companies, or there's BetaShares has a global defense ETF, so they're probably relatively popular at the moment, I would have thought, where you're investing behind businesses that are sort of driving defense contracts and those sorts of things. So you want to steer clear from those types of ETFs. And I actually recorded an episode back in June 22 where I sort of spoke about thematic indexing. I didn't have episode numbers, but it was published on the 21st of June 2002. And you can just Google it, should future trends drive your investment decisions? And essentially what I was saying back then is that, you don't need to use thematic investing because firstly, you got to try and pick the tea leaves and work out what's going to happen. And you may or may not be right on that, but also mainly because the market will work it out. Like the market will work out who's the winners and losers. And you don't need to become so focused on one particular thematic, just sort of buy the whole market if you like. And I think thematic investing is pretty much like active investing, really. That's what active investors are doing. They're trying to look for the trends. They're trying to identify where the future returns will come from. And remember, there's an overwhelming body of evidence that if the professionals that are spending 80 hours a week studying markets, interviewing CEOs, reading, researching, educating themselves, and if they're dedicating all this time and have a natural talent for it, and if they can't beat the market over the long run, then what chance do you have? So that's why you don't want to choose indexes that are thematically based. You want to choose indexes that you're happy that so broad based that you're happy to hold them for the next 20 or 30 years. So that's the first pass. They've got to pass that quality test. And also with respect to those indexes, of course, the methodology behind the index needs to be something you're prepared to hold for forever. So when you're looking at methodologies, whether it's market cap indexing or some sort of factor base or dimensional, you want to look for an index that has the robustness, that has been tested, that has stood the test of time, that has, historic results that demonstrates it's able to produce an alpha, a better return in certain circumstances. So quality first is the first step. The second step then is to focus on the price of that index. And really, at the end of the day, your long-term returns will be driven by the quality of the asset you buy, or in this case, the quality of the index, the price you pay for it, and how long you hold it for. You can't control the future, but you can insist on buying something that's high quality, refuse to overpay, and then give compounding enough time to be able to do its work. And that's really what I would call a value-aware asset allocation approach. And I think this is where a lot of investors make a lot of mistakes. They chase what has done well. They look at just more recent returns and think, okay, that's it, I'm jumping in. And there's a lot of studies that show that most people are too late to the party and miss the returns. If a particular thematic or market has done really well, most of the returns are enjoyed right at the beginning of that momentum rather at the end of it. And also research tells us the price paid for an asset is one of the most dominant drivers of future returns. If you overpay for an asset, then what you really need is that organic growth to eventually bail you out, but that's not always going to be the case. So with respect to quality indexes, then it's about buying them when they're cheap or at least reasonably priced, and you improve the chances that you're going to generate some good returns. So from a practical perspective, how do you do that? Well, almost all ETF providers publish fact sheets and index methodology documents. So the data is there. It's all available online for free. It's just you've got to go looking for it. And so these fact sheets usually tell you things like current or forward PE ratios. They give sector exposures, geographic exposures, and other sort of valuation metrics and tools. That's useful information and you should be looking for it. And that gives you sort of a good guide for, is this index fairly valued? Does it look expensive? Or is it priced to a point where it becomes very attractive as an investment opportunity? And I think it's really important to understand that your returns are going to come from three sources. When you invest in an ETF, or really any share investment, almost really any investment, including property actually, it's going to come from three sources. The first source is income. Well, that should be pretty obvious and should be relatively easy to ascertain. The second source is just organic growth of the earnings that the companies that make up the index. So obviously that's the earnings is what sort of drives valuations in the long run. In the short run, it's sentiment, but in the long run, it's really company earnings. And what you hope to do is invest in an index where those company earnings are robust, stable, and growing. And as they grow, of course, then the company becomes more valuable. And the third source of returns is repricing. And that's where an index can move from cheap to fairly valued or from fairly valued to expensive. And this is where kind of a value aware ETF portfolio construction is simply just trying to maximize all three of those sources of returns. So if you buy an index that's expensive, you might actually have a negative repricing effect. So you might have the underlying earnings growth, you'll have the income, and then if the repricing is negative, that's going to be a drag on your overall return. Whereas if I invest in an index that is high quality, that is cheap, then I'm going to pick up the income. I'm going to pick up the organic growth underlying the index. And then eventually, with some mean reversion, I'll pick up that repricing effect. So just to recap then, the two steps: start with a quality index. It's got to pass that filter first. It's got to be something that you're prepared to hold for the next 30 years. And then the second step is really to look at the underlying valuation and try and buy something that's high quality, that's attractively priced. And really, there's going to be four ways to kind of tilt your portfolio to achieve that value aware asset allocation. And so that's what I want to talk about next. So the first one is geography. So you can tilt towards geographical markets that might be better or more attractively priced than other markets. And I've used this example over the last couple of weeks, but it's a good one, so I'll keep using it. You want to be careful that you don't want to have too much concentration in one geographical market. So you need to understand where the revenue and earnings are coming from for those companies that are listed in that index. And so, for example, if I look at the UK market, so the FTSE 100, top 100 companies listed on the London Stock Exchange, approximately 80% of revenues are generated globally. So whilst I might go and invest in the FTSE 100, that's not really a UK investment per se, because those businesses are global businesses and they're earning their revenues overseas. But for example, you compare companies that are listed on the London Stock Exchange versus the New York Stock Exchange, you can see where the valuation differences show up. So for example, Johnson & Johnson, which is a sort of pharmaceutical consumer goods company in the US, is trading on a PE of sort of 21, north of 21 times, which is pretty expensive. When you look at GlaxoSmithKline, which is a pharma company listed on the London Stock Exchange, it's trading on a PE of less than 15 times. And they're both global businesses. They're both different sort of businesses. They're going to have different exposure. I'm not saying they're perfectly comparable, but they're comparable in terms of industry and they're comparable in terms of exposures. I mean, Johnson & Johnson is a much larger business, of course, but it's showing that, there's significant mispricing, I guess, between two companies on two different markets. That example works for the UK market, but it's not going to work for every market. The different markets can have different leanings and exposures. For example, the UK market has a greater concentration in financials, where that happens to a lesser extent in the US. So you've got to think about sector exposure, and we don't want to turn into active fund managers where we're taking massive bets. So I'm not suggesting you go and put all your money in the UK market, for instance. That would be taking a massive bet, and that would be active management rather than an evidence-based approach. The second way you can tilt your portfolio is through index methodology. So this is where index methodology still might give you exposure to a particular geographical market or index spread, but maybe at a better price. And one useful example at the moment is, say, traditional market cap indexing versus equal weight. So if you look at the US market, the PE ratio on the S&P 500 currently is about 26 times, very elevated, very expensive. Whereas you look at the equal weight index, it's about 18 times, which seems closer to fair value, a lot closer to fair value than the S&P 500 index. So, one is investing across using market cap indexing. The other one's just putting 1/500th into each company that's listed in the S&P 500. Now, they're both going to give you different exposures, of course, because the equal weight is going to give you a greater exposure to that mid-cap market. It's really a mid-cap investment index rather than, a traditional market cap index. So they're different exposures, and you've got to make sure that you're accommodating that in your asset allocation. You're considering the impact of that in your asset allocation, but it shows that different indexes are going to be more attractively priced. So for example, for the last 5 years, I've been talking about a value aware approach. So some value-based strategies will naturally, by definition, have a more attractive price. So if you look at Vanguard's Global Value ETF, VVLU, it's trading currently on a 13 times PE ratio. So again, it's pretty attractive, and that's where you're going to get the sort of repricing effect on your return. So that's the second way you can, expose your portfolio to that, greater sort of value aware approach. The third option is company size. So there's been overwhelming studies and dimensional. The index manager dimensional, it certainly builds its portfolios around this concept that the smaller the company, typically the higher the future return. And that kind of makes sense, right? Logic tells us that when you get a very large, mature company, that probably already has significant market share, it's difficult to grow. Whereas if you've got a new entrant into a market that is likely, or if we had, ability to predict the future, that we could see that it was going to succeed and grow into a very large company, well, that growth trajectory is pretty significant. Nvidia is probably a good example of that, for instance. And so what dimensional does is it skews towards small away from large within an index. Well, that might be a way to sort of capture some returns. So if we went back, say, 2-3 years ago, small cap companies were really cheap. So there's a few global small cap ETFs out there. VanEck has one, in fact. And at the time, they were relatively cheap. So, for example, VanEck's one is QSML. Its forward PE is now 19.5 times. So it's not that cheap anymore, but over the last 3 years, it's had a 13% compounding return. So that's probably just some of that repricing effect that has happened over the last 3 years. And then the final sort of tilt you can employ is going to emerging markets, so away from developed markets. Normally, you wouldn't have a substantial allocation towards emerging markets. That's the conventional wisdom. It's the same conventional wisdom that results in people investing 35 to 40% of their portfolio in the Aussie market. So let's not get too attached to conventional wisdom. But the thesis behind not putting too much in emerging markets is that they tend to be higher volatility. And that's true, that they are higher volatility than what developed markets are. But if you really think about it, and I went to a presentation many years ago where the fund manager was talking about the fact that, that's probably where the growth's going to come from. The developed economies tend to grow at 2 to 3% per annum. Now, of course, companies within that developed economy can grow faster than that, but really emerging markets can have significant growth. So, for example, it's not happening anymore, but, China was growing at 9% per annum. And, in a rising tide, all ships rise. So you could argue then that, emerging markets is where the growth is going to come from. And some ETFs out there that might have a forward PE ratio in emerging markets of 11 times. 11 times, that's really, really cheap. And if we think that this is going to be an index that's probably going to have higher growth than developed markets, I think that's a reasonable expectation. Not every year, of course, but over the long run. Then it's another example of how you're going to be able to tilt portfolios to be more value aware. So just to recap, the 4 ones: geography, so picking a particular market and avoiding other markets that looked a little overcooked. Index methodology. The third one is company size, and the fourth, emerging markets. And I would say that we would use all 4 of those all at the same time to construct a portfolio that we don't want it to be too far away from the MSCI index, from the general sort of global index. But what we might be still underweight US, for example, but we're going to be using different strategies in the US. We'll be using value aware, we'd be using equal weight indexing, but even after accounting for that, we're still probably underweight US. We're going to probably be overweight Europe and the UK just because it's more attractively priced. We're probably going to be underweight the Australian market. And we can do that ongoing as well. So we might have, for example, a 30 or 40% exposure to the Aussie market. I'm not saying you go and sell that. And in fact, Campbell said the same thing in February when he recorded that episode. But it's also a way to think about how am I going to add new capital to this portfolio. So if I'm adding new capital to a portfolio, to my mind, I want to invest in an index that's most attractively priced that I'm prepared to hold for the next 30 years. And I'd rather put all my new money into that index than take a very strict approach and just invest it diversified across the Australian market, international markets, irrespective of, how attractively they're priced at the moment. And if you take that approach, what's going to happen is there's going to be times when, Europe is the most attractive, and then there's going to be times when Australia is most attractive, and times when the US is most attractive, or emerging markets are more attractive. And over time, you will build out a relatively diversified portfolio. Now, as I said, you can use value-based indexes that are going to give you global exposure. So it means that you can sort of build a portfolio, and still, I wouldn't abandon traditional market cap indexing as well. So you can still build a portfolio, as I said, that's relatively diversified. What might not be diversified is how you're contributing new capital to that portfolio. And to be honest, personally, I would rather an imbalanced asset allocation initially if it was most attractive. So for example, if I was starting a portfolio from scratch today, I'm probably going to be putting my money in emerging markets and the UK and Europe. And, I might have a bit of small companies in there, and I might have a little bit of equal weight US. And if I start with that portfolio, anyone could critique it and go, it's unbalanced. It looks a little bit too active, and I would agree 100%, but I would be happy with it. I would be more happy to have an unbalanced portfolio for a while if I had high conviction around how it was invested and its future returns than going for a perfectly balanced asset allocation, but having lower conviction about future returns. And I just think over time, I can build that out. Over time, I'll be adding more US exposure or more Australian exposure, and eventually I'm going to have a relatively diversified ETF portfolio. Now, I should say, we measure these things on a portfolio by portfolio basis. So I should say our portfolios at Pro Solution are relatively well balanced, but we will have certainly portfolios that will be overweight emerging markets or aggressively underweight US. That does happen, but as a general rule, the best thing to do is not move too far away from the broad-based index for too long, because that's really where all the evidence tells us that that's where the returns are going to come from. I mean, you can't agree with indexing as a strategy that beats active management and then use indexing as an active management tool, right? Because that's contrary to the evidence. So it's okay to do that for a little bit of time. And as I said, I'm not going to just blindly invest in the US market cap indexing just because, that's what we should be doing. So you still want to be value aware. I feel like I'm prattling on, but hopefully I'm making that point relatively clearly, because I don't want anyone to listen to this episode and then misuse, as I said at the beginning, misuse the information in a way that we wouldn't apply it. And look, the final ingredient to this approach is time. Hold that ETF forever. So, for instance, if I go and buy a emerging market ETF, something like EMKT, which is a sort of value aware Van Eck emerging market ETF, I might buy that because it's at 11 times PE at the moment. But I like the index because it's got a factor filter, and, I like the exposure in terms of emerging markets. I'll hold that investment for the next 30 years. Over the next 30 years, there's going to be times when it's overpriced, and I might trim back then at that time. I'll try not to, I'll try and dilute any overexposure with new money by not investing in emerging markets, for example. But really, the whole point is what I want to reduce my cost drag. So I reduce my cost drag by minimizing fees and also, most importantly, minimizing turnover. So I don't want to sell the investment and trigger capital gains tax, or sell the investment and trigger brokerage, although brokerage isn't that expensive these days. But really, it comes back to the initial thing of buy a high quality investment and then hold it for long term and let compounding do its thing. So buying that index initially when it was cheap, what it's going to do is just reduce risk in my portfolio, reduce risk of that new capital being deployed into the market. It'll most likely mean that over the next 5 to 10 years, my returns are going to be better than average, which puts me off to a great start. And then I'm going to hold that investment for the next 30 years. And I hope over that time then, or at least the evidence tells me, it's going to generate some really good returns. Partly because the initial period was better than average, but also, and most importantly, because the original identification of the index was all about quality and really passing that forever test. What you don't want to do is build a ETF portfolio and chop and change your holdings all the time. We would buy a holding and never sell. There'll be very, very few investments that we have sold for our clients. So just to sum it up then, if you want convenience, if you want something simple, if you want something that's going to be behaviorally simple to follow, a diversified ETF is a perfectly reasonable solution. If you want more control or the amount of money that you're investing is more substantial, then building a bespoke ETF portfolio using the two-step approach of identifying a forever index and then buying it when it's attractively priced is the right approach, as long as you do it properly and you don't misuse that approach. I mean, the framework is simple. Choose quality first, then consider price. Always use a rules-based methodology. Stay diversified, keep friction low. And then once you've built the portfolio, give it the time to do all the hard work and heavy lifting through compounding and mean reversion. Okay, there you go. I'll leave it there for today. I hope that's been useful and interesting. If you've got any questions, of course, questions at investopoly.com.au or jump over onto YouTube. I answer plenty of questions there. And until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.